next presentation is Alex Rovira. He's Managing Director of Brightstar Resources, working on the Laverton and Menzies gold projects. Alex is also a nominee for our Emerging Leader Award this afternoon, so please welcome Alex.
Hi all, thanks for having us along here. So I'll be talking today about the Menzies and Laverton gold projects, for which we've just released a scoping study a few weeks ago. So here we are. Just skipping through the usual disclaimer slides. So just as a quick overview, this is where our project areas are located in the eastern goldfields of Western Australia. So we've got the Laverton gold project, funnily enough, located in and around Laverton, and the Menzies gold project. We've got just over 1 million ounces in JORC resources. All those resources are located on granted mining leases. The infrastructure is fantastic. The Menzies Gold Project is a 9 iron away from the Goldfields Highway. We've got a processing plant and infrastructure and non-processing infrastructure up in Laverton. So we're blessed with the resources, where we're sitting from a tenure and permitting perspective, and importantly, the infrastructure as well. We just released a scoping study into the refurbishment and restart of mining operations. What this showed is essentially just a snapshot in time of a few months ago when we consummated a merger with a company called King West Resources, which was announced in December. That completed in May. So what this looks like is restarting the operations. It's just over 320,000 ounces produced over 8 years, so an average of just over 40,000 ounces per annum. Importantly for us, we really designed and focused this whole study on having something that was deliverable and fundable. And really in this market, I mean, the panel touched on it. Everyone that kind of investing at the moment knows equity markets are really tough. Debt markets are really tough. You know, single asset gold developers in Western Australia hasn't been a great place for investors and equity investors in the last few years. So everything that we've done and what we're trying to do in this business is to take the risk out of what we're looking to do. And one of the key risks is funding. And so for us, we've gone through a staged approach where we go into mining Menzies first, using the operational cash flow out of Menzies to get into Laverton. So that way we can use organic cash flow to do things like refurbish our mill, pre-strip requirements and things like that. So what our CapEx requirements are is $22 million pre-production. That's delivered an NPV8 of just over $100 million and an IRR of 79%. That's using Aussie gold of 2,900 per ounce. At spot, the IRR is over 100%. So immediately you go, okay, an IRR of 100%, very fundable, great return on investment, low CapEx, gets us in there. And you know, we're pretty comfortable that there's significant exploration upside. The mine plan touches about a third of our resources. So there's a significant opportunity to bring more of those ounces into the production profile with infill drilling and further studies. We've launched straight into a pre-feasibility study. We're hopeful to have that completed midway through next year. Just touching on a few of the key metrics here. So just over 5 million tonnes processed at 2 grams. A couple of the key call-outs, the cash cost there of $17.65 per ounce. We think that is incredibly robust. We've done a lot of work to ensure that what we say is real, and that we're not going to see a scenario in which we go mining and all of a sudden those costs are 2x or 50% higher, and all of a sudden investors are saying, guys, how have you got this so wrong? So we've kind of been very robust and diligent with our cost profile. We think that's the key area that companies are tripping up at the moment. So something for us was a big focus. I suppose a couple of the key call-outs here is the things that I look at as an investor is really just, it's the why. Why are we doing this? What are we actually doing? And for me, that comes back to the return on investment. So that's really best exemplified by an NPV on pre-production CapEx ratio. So that ratio there of 4.6 times really is almost peer leading in the WA gold explorer / developer landscape for companies with pre-feasibility or scoping studies. That delivers really low capital intensity and a sharp payback period. So what this project is, it's fundable, it's buildable, it's de-risked, and what we're doing is going to make it better throughout the PFS and DFS and march it towards production. Just touching on the corporate overview, current market cap is circa $23 million. We've got $3 million in the bank, so circa a $20 million EV. Relatively undemanding valuation, I suppose you could call it, from an EV per ounce perspective in the ground. Notwithstanding the fact that, as I said, all our ounces are on granted mining leases. We've got infrastructure. Half of them are measured indicated status. So there's a number of things that we think that we can really work towards to seeing that re-rate occur. This is just a snapshot into the production summary, so it really splits out the project areas. So what we're looking at is the Menzies Gold Project and the Laverton Gold Project. It's 4 mines, so 2 in each, an open pit and an underground in each project area. You can see on the colour scheme there that this is the Menzies Gold Project here to start with, an open pit at Lady Shenton and underground at Yandega. That produces sufficient free cash then to refurbish our mill and expand our mill on Laverton and get the Corktree Well project up and running. So at current spot, that's almost $200 million of EBITDA, life of mine, and at the moment we're working through our studies. And I suppose everything we're doing here is really getting the sequencing right such that we can get the best use of the synergies, we can get the best use of people and infrastructure, and it's really just trying to A, minimise equity dilution, and B, trying to reduce the amount of debt that we do need to get into production. And obviously interest rates, we've talked about it, they're pretty high at the moment. But probably the key thing with debt for financing these kind of operations is the hedging requirements. And you're seeing some of our developer peers really, I suppose, struggling with the hedge books versus where the spot is at the moment and their cost profile. So for us, minimising debt, minimising hedging and minimising equity dilution is kind of the name of the game. I will whip through a few of these slides. Apologies in advance, there's a lot of detail here and I can see the clock ticking down. This is just touching on the production profile. So you can see in the first couple of years it's 50,000 ounces and 63, and then kind of tails off to an average of 45,000 ounces for the first 5 years. We see the traditional drop off here towards the back end of the mine life. That's where we're doing infill drilling at the moment and really just trying to extend that mine life. So for us, the two things we're focused on from an exploration perspective are increasing mine life, but probably more importantly is really increasing the production profile in the early years. Logically, they're the years that make the most difference to your NPVs and your IRRs and the financial returns. So we're looking at opportunities for focusing on grade early in the mine life and just bulk tonnes towards the back end to really just delineate that mine life. This is just the key study outcomes here. I won't go line by line, but you can see the costs are split out in terms of dollars per ounce and then also on the unit costs. Just shooting over to the right-hand side, you can see the metrics there that I touched on, the IRRs. Really, you look at spot, you can start to see it starts to make a pretty big difference. Logically, a project of this size and scale is very sensitive to the gold price. So we've done a bunch of sensitivity work, analysis work, looking at, worst case, let's say the gold price does go down, doesn't work, well, yeah, we've still got an IRR of over 50%. So even if the gold price was to drop $200 an ounce from current spot, we know that still makes money and it's still less than a 2-year payback. So for us, we're really looking at the upside, but we think this project's defendable and buildable, even in a tough equity market, and if the gold price does come back. Just touching on the costs here, this is a traditional water flow chart of the cash costs you can see there. We think there's significant scope to bring down some of these cost line items as we get towards production through the feasibility studies. The key one's probably around the processing costs. At the moment, we're looking at a toll milling scenario out of Menzies through one of the third-party mills in the district. There's a number there. We've assumed some pretty robust pricing assumptions there based on live conversations we're having. And also our own mill, once that's back up and running in Laverton, there's scope to increase the throughput to drop the unit costs accordingly. I'll quickly just go through the projects in a little bit more detail, but knowing that there's not a whole lot of time. But this is essentially the snapshot of Menzies. This is the Goldfields Highway that runs up here. This is the town of Menzies. Menzies is historically a very high-grade goldfield. It had mined 800,000 ounces at nearly 20 grams per tonne. Historically, what we're looking at doing is going back in and really just restarting operations for the first time in a number of decades. So what it looks like is an open pit or a series of open pits up at Lady Shenton and an underground down at Yandega. This is just looking at the pit shapes and the underground stope shapes and looking at the physicals there. I'll let you read through that in your own time. One of the key things for Menzies, I suppose, is the Yandega underground for us as a key growth opportunity. Our mine plan goes down to 190 metres. It was in another lode at Yandega, mined down to 600 metres 100 years ago. It's incredible, kind of the feat of human endeavour to do those things pre-World War I, mining down to 600 metres, and we're going down to 190. So there's significant scope. We've got drilling underneath it that shows that it's open. Very confident that once we do get back underground, that mine life's going to continue. This is just a quick overview of the production coming out of Menzies specifically. As I said, there's about a 3-year mine life there. We're pretty confident that we'll be able to bring additional resources that we do have already delineated and also through further drilling to bring that into the mine plan to see that continue. Just shooting over to the Laverton Gold Project, this is what will be commencing in years 2 and 3 of the mine plan. So this is Laverton here. For those of you that don't know or aware of Laverton, it's a great part of the world in terms of mining infrastructure. You know, you've got some pretty significant deposits, you know, Granny Smith, you know, Wallaby, Sunrise Dam, these are all 5 to 10 million ounce ore bodies being mined down to 2 kilometres. We've barely scratched the surface. So this, for us, we feel like the majority of the resource growth and the potential really sits within the Laverton Gold Project. Just shooting into Corkscrew Well specifically, this is, I suppose, the bulk of our ounces at Laverton and within the project portfolio in general. This is 300,000 ounces in a current resource. With this, the mine plan that's been delineated at the moment that's optimised is 136,000 ounces that then trucks down to our processing infrastructure down in Laverton. Total mine life or total production profile is just under 170,000 ounces out of here. Significant opportunity to continue to grow this. As I said, it's really just bringing the resources that we do have in the resource into the mine plan. We're looking at ways to, I suppose, once we've got the mill up and running, really engaging with third-party operators in the district as well, whether that's from an M&A perspective or toll milling. There's definitely a lot of stranded ounces in that part of the world that could certainly do with a processing solution. And this is our mill here. So this was last run in 2012 by Brightstar when it was previously known as Stone Resources, been on care and maintenance since. We engaged GR Engineering to do a study into the refurbishment and expansion of this. They basically had carte blanche to go through and tell us what's the best kind of outcome. We looked at, you know, making it a lot bigger, just turning it back on in the current size, moving it to Menzies, building a new one, like everything was on the table. It was a pretty significant study with GRES. The best opportunity and option looked like refurbishing it to 500,000 tonnes per annum, fresh rock throughput. And for us, that delivers about a 35 to 40,000 ounce per annum profile, 5-year life of mine, and really a lot of potential to increase that modularly as we go through from cash flow. I'll just go back, sorry, just to touch on. So we've got a number of things here that add a lot of value to our business that I feel like are not encapsulated in a 20 mil market cap, but, you know, sorry. I will go back. We've got a 60-man camp just tucked up in here. You know, we've got a permitted and operating tailing storage facility down here. So we'll look to do a lift at the TSF and then utilising in-pit tails. We've got a significant amount of infrastructure here with airstrips and yeah, things like that really, it really is a big value for our business that's not really being valued. I'll just touch on this one quickly. There's a lot of data here and I would encourage you to go back and look through. But what we're trying to present here is essentially, these are all the explorers and developers in Western Australia that have mining studies released to the market. You know, there's a number of companies up here that you'll all know and love and their various studies. And what we're trying to show here is the outputs and really just the assumptions used. And what we're graphically representing up here is that NPV on CapEx ratio that I discussed at the start. So for us, for every dollar we spend, we get $4.6 back. If you look at our peer group, you know, it's significantly lower than that. For us, if you look at the producing peers, the companies that have actually been funded and built and are mining at the moment in the last 5 years, so Pantoro, Bellevue, which is in construction at the moment, Red 5 and Calidus, you can see their NPV on CapEx is kind of in and around that 4 to 5 range, which is where we sit, and similarly low capital intensity. So we have similar metrics to companies that have been funded and built, and we have arguably better metrics based on these assumptions than I suppose our developer peers. And for us, was a key, I suppose, focus of our study, and what we're doing at the moment is to really deliver a project that is fundable and buildable and makes money. I'll just go through the upside that I've mentioned. So for the 2 project areas, it's really just how do we get more material into that mine life? 40,000 to 45,000 ounces per annum. It's kind of, you know, are you subscale? Potentially everyone likes to see that 100,000 ounce producer. I suppose what we're looking at doing is building a business that works and then expanding thereafter. We could have done this mine plan such that we were mining Menzies and Laverton concurrently. We would be a 100,000 ounce gold producer. Your CapEx goes up 4x. You've got significantly more risk in the business. You're mining 2 project areas, 4 mines, and refurbing a mill. To me, that just screams risk and that screams, you know, downside potential. So we've tried to manage this appropriately. So just touching on, I suppose, the key opportunities for us, it's really just infill drilling and extensional drilling, bringing more ounces into that mine plan. We think there's a significant opportunity for grade at Menzies. We just recently drilled an area called called the Aspatia prospect. We hit high grade underground in 18 of 19 holes. There's no resource on that yet. We think that could be a pretty modest but a high grade resource to bring into the mine plan. So what we're looking at doing is bringing ounces and grade in the early years and then mine life in the back end through Laverton. I'll leave it on this because I've got 15 seconds left, but this is just I suppose a snapshot of where we see ourselves moving forward operationally, an exploration up here, and then the project study stage. So scoping study completed. We're ripping straight into a pre-feas and then a DFS. We're hopeful to have everything permitted and completed back end of next year into Q1 25 and really be making final investment decision. Luckily for us, it's a really quick rip into production. It's a small camp build and essentially getting into mining at Menzies. So production, circa 6 to 9 months thereafter. So we think there's a bit of opportunity to compress this timetable, notwithstanding it's relatively sharp as it is. So I will leave it there. Thank you, everyone. Okay.
We do have time just for one question. Thanks for keeping to time, Alex. As a convener, that's very helpful. You talked about managing capital risk, which is obviously a big challenge. As a small company, though, you're taking on technical risk in development and obviously producing. What's the management strength in terms of managing that risk?
Yeah, that's a really good question. So we've made a number of key hires, I suppose, in the last few months to go into that. So we've appointed a chief operating officer that's sitting in the room. He's ducked out to man the booth. He's got significant mining experience as a mining engineer and first-class mine manager ticket, etc. So for us, it's having the right people in the business that I suppose share the same philosophy of getting there and getting our hands dirty and building something that works and then growing thereafter, as opposed to being stuck in a perpetual study stage of releasing an updated DFS every 12 months and arm waving. We'd rather go mining.
Excellent. Thanks, Alex. Thanks, Alex. Thanks.